to be a really great event. The speakers that are lined up, and I appreciate being part of this. So that being said, let's get started. So what I'll talk about here today are some really great option strategies that I think every trader needs to know and understand how to use. So we're going to talk about some of my favorites here, the butterfly, long condors, and more. But these are strategies that are really perfect for any trading environment, especially though when you're in a high volatility, uncertainty type market environment like we're in now, because you can really keep your risk, capital at risk, super low, and they're great for hedging. So that being said, let's get started. So the following webinar today is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. So to me, the secrets to profits in trading really comes down to utilizing options. And so what if you had a trading strategy that could really turn around losing trades and maybe even turn those trades into winners? And what if that same strategy could capitalize on the two main option pricing components, which is time decay and volatility or volatility collapse, more than any other method? So would this be worth your time to learn it? Now, over my 30 years of trading options, I've found that the most valuable go-to option strategies that can really literally help any trader more than any other trading strategies out there are known are the butterfly and the long condor option spreads. So the huge advantage of these strategies are their unique option framework that allows you to construct trades that are going to provide you more consistent and greater returns in any type of trading environment, and especially in a high volatility market due to their simple but dynamic structure. Now, because they are structured to require only a small amount of your hard-earned capital, your trading returns are going to be greater and your trading stress is going to be a lot less. And that's a really major win-win for any trader out there. Now, butterflies and long condors, they're also very dynamic, and they can be traded for a variety of different reasons with different goals in mind. So in other words, you can learn how to trade the butterflies and long condors, and you're going to be covered for both your offense profits of your trades and also defense hedging, so goals and protection. Now, these type strategies can work no matter what the markets are doing. They can be up, they can be down, they can be sideways. They can really help to provide income from stocks that are going nowhere. Helps to eliminate the stress of having to be perfect on a stock's direction and overall market. Eliminates the time decay expense that you're going to encounter from decaying long options. Takes the unsettling guesswork out of your trading, and these strategies can be structured for very low cost and low capital at risk, which can offer you the 10-to-1 or higher returns on your risk that's at risk. So you'll see a lot of examples here today. Now, they also, butterflies and condors, they're very flexible, as you're going to see ahead. And once you just learn the basic fundamental setups of the structure, you can then adapt these option strategies for both your goals and your market insights. So they can become kind of a delta neutral strategy for you, or the real beauty is that they can become a directional strategy offering you a bullish or bearish exposure to the market when you feel pretty sure a stock is headed one way or the other. But if you're wrong, this is the big plus. If you're wrong, the butterfly and the long condor is going to really help you to manage and keep your risk low, but at the same time being able to retain a large potential return. And that's what really makes these a great strategy, a very win-win type of trade strategy. Now, let's be real about this. Now, when we use option spreads, we're going to have a kind of a limited potential profit. No, it's not going to be unlimited like if you just buy calls or something, you have unlimited potential upside. But if you do spreads and utilize the strategies that I'm going to show you here today, they're going to usually cost you a lot less than buying outrights. And as you're going to see, they offer you an amazing risk to reward trade setup. So this means that the butterflies and the long condors can significantly increase the probability of your winning trades while also reducing your risk. And that's really what it comes down to. So for me in trading, it really comes down to direction, timing, and then managing your risk. And these are fantastic for that risk management component, and they offer you great potential returns on that low capital at risk. Now, the butterflies and long condors, they can also be used for hedging when you mess up. Now, they can be used as a fast, really low-cost way to cover your you-know-what pronto when a position moves against you. And I've found no other hedging strategy that even comes close to incorporating these strategies into your trading for hedging specifically. Now, by constructing either a butterfly or long condor around a strike that is under pressure from another core position or trade that you have on, such as maybe you set up a credit spread that starts to go against you, or you have a debit spread that goes against you, or you could have started out with calls or puts. You can always convert these, and the end result, you can convert it and hedge it by a butterfly or condor. So this becomes one of the best ways that I've found to immediately neutralize that risk. It will lower your risk and then control that risk. Now, what you can do, and this is the beautiful part of it, you can keep your original position open for a while just by implementing either the butterfly or long condor hedge on your original position. So this hedging strategy, what it does is it takes advantage of that time decay component while you wait. And many times that's really all you need, right? So just a little bit more time for that original trade position to stabilize, then move back into the favor of your original trade. At that point, you can then just remove the hedge, stick with your original trade, and ride it for what it's worth. So this is really what's great and dynamic about these strategies, is the component that you can incorporate into your trading for hedging. Now, when we look at the butterfly, they're pretty simplistic. So this is a typical kind of structure. So here's a call debit spread. You can use calls or puts, but in this example, you'd be long a call here, short a call there. So there's your call debit spread, and your risk here is your debit paid of $300. Now, I never want to lose the total at risk, so I could easily convert this trade or neutralize this trade by turning it into a butterfly. And then all I would really have to do is sell against this a bear call credit spread, sharing the same short strike as the call debit spread. So here I could sell a bear call credit spread. I'd sell the call right here, short, and then buy a call here. So there's your bear call credit spread. I'm going to bring in $200 credit. So that just reduced my trade, neutralized the risk from 300 and reduced that risk all the way down to $100. All right, so now I just created a butterfly, and what we call a balanced butterfly. It's a combination in this example of a call debit spread and a bear call credit spread, and I've reduced my risk to 100. So now I've got a lot of different things I can do. I can leave it on as a butterfly, and if I go out in this profit zone, I could make a really good profit on the return on my capital at risk, or I could leg out. I could close out the debit spread side or the bear call credit spread side. But the main thing, it buys you time. And a lot of times that's all you need, is just a little time to kind of figure out, okay, what's the market going to do next? And you don't have to worry about all that risk that you had on that original trade. So you knock that down to, a manageable position, like in this example, to $100 per spread. Now, the long condor is very similar to the butterfly, but what it does is it widens out the spread width between the short strikes, okay, between the short part of the spread. So here would be like your butterfly, right? You're sharing the same short strike here. So you'd be long a call, short a call, then short this call at the same short strike, long call here. But the condor, what's great about this is we can widen out the width of the spread right here to give us a bigger profit zone in here. So in this example, we could be short further out in time the call credit spread. All right, so we've got a bigger profit zone for this trade. So I love this structure, especially when we're legging into a trade. So I could start out with a call debit spread or put debit spread. And then if I wanted to, I could convert it to the long condor, neutralizing, reducing my risk, but still maintain a big, huge profit zone for that trade, and actually increasing the risk reward, or the positive risk reward return to the trade, by adding that additional credit spread. Plus, what this does too is it also reduces your theta decay of that trade, which is huge. So it's got a lot of benefits. So let's take a look at the core concepts of the butterfly long condor. So when we look at options in general, the most important option factor really for option generation of profits or income of a trade, and especially when we're looking at butterflies and long condors, come down to understanding the option pricing, how it works, So to understand the concept of time decay and its impact on the option price. So time decay, or what we refer to as theta, and how that affects your price of the option. So we'll review that core concept, but let's take a look at what that really means. When we look at theta, what that tells us is how much an option price will go down over time, which is the rate of time decay of your stock option. Now, this time decay occurs because that extrinsic value, or that time value of your option, is going to go down, and it gets starts really increasingly decays as you get closer and closer to that expiration. So all options will go to, time decay will go to zero, and the implied volatility, or volatility, goes to zero. So we can take advantage of those two major pricing components. Now let's take a look at the construction of the butterfly and the long condor next. So here's a good example to show you how small the risk can be, but how huge the return on that risk can actually be. So let's say we're taking XYZ and it's trading at $45. Now we're looking for it to move down to 43. So the directional move down, and not very far. You know, these can be set up for short duration and small moves, but you can still make huge return on your capital at risk. So in this example, we'll buy the March 44 put. It's going to cost $2.38 or $238. And then we sell the March 43 put against it. So you can see here that'd be a put debit spread, okay? Now we're going to sell another 43 put, get another $1.67, buy the 42 against it for $1.06. So if you look at this, you add up the debit spread cost, you've got the 238 cost of your 44 put, you've got the 106 cost of that 42 put, and then you sold the 43 put twice and brought in $1.67 times 100 to convert it to an option contract or spread. So this would cost $10. That'd be the maximum at your risk. It's a debit paid of 10. Now your profit, you just take the middle strike, 43, less that lower strike of 42, less the cost of the trade, $10. And that's going to end up, you know, with a potential theoretical profit here of 90 cents or $90 per option spread, right? So that's basically a huge return on your capital. So you've got $90 potential profit, $10 of risk, so that's a 900% return, or you're risking $1 to make potentially $9. So even if you made 50% or whatever, that's a huge return on your risk. And we can then control the butterfly by the spread width. So we can make it narrow or wide and create that bigger window of profit, and also then increase the amount of profit you make by the width of the spread. So let's look at the best butterflies and condor strategies for your trading goals. That's kind of the next step. Now, the capital required is just the debit paid. So it's not, because these are made up of a debit spread and a credit spread, but the actual cost of the trade will be a debit cost. Now, when we're looking at the option strategies, one major goal, in my opinion, of every trader should be to select the trades that are going to be best suited to provide you the most consistent positive return with low defined capital at risk and not always the greatest return. So I'm looking at singles, doubles, and then occasionally you're going to get that triple or home run. But if you keep your trades under control with a really manageable low risk, you're going to stay in the game and you're going to just be consistently, making profits, in a smoother equity curve. And so one of the best ways to achieve this is being aware of the different option strategies that are out there and available to you, understand how they work, and then select the one that's going to be best suited for the market environment you're trading and your specific goals. So, everybody here today is going to have a different amount of capital you trade. Vicky might be trading $100,000 worth of capital, and Wayne might be $10,000. So it's going to really make a big difference as to the strategy that you use. But one thing that you're going to find out once you get into using butterflies and condors, long condors, is you can use a small capital account or a big capital account. It doesn't matter. And the thing is that you can have a $5,000 account, start using these strategies and turn it into a nice size account, or you can have 100,000. It doesn't matter. They work with regardless of the account size. Now, when we look at the butterfly, I call it kind of the butterfly strategy or family. And there are a lot of different variations. You've got the long call or put butterfly. We've got what we call a broken wing or skip strike butterfly. We can use calls or puts. We've got what I call the ninja butterfly, which is an unbalanced ratio butterfly. We've got a wide wing butterfly, iron butterfly, hedging using the butterflies, and then the long condor option spread. So there's multiple different variations of these, and I'll show you a lot of different examples of these variations here next. Now, when we look at the different kind of main different ones, you've got your directional kind of bounce butterfly here. The first one I'm showing you right here. And then you've got this is what we call a broken wing butterfly, and this is a ratio butterfly. So basically what you're seeing here is kind of this balanced butterfly, all right? So you're long the 203, call here, short a 205, call there, and then long the 207, short that 205 again. So this creates a balanced butterfly. And in this example, you can see your risk is $40. If you take, your total debit minus your credit minus, the debit. Now the broken wing butterfly, what this does basically is you skip a strike. So here, instead of buying the 207, you skip out a strike or two, as many as you want. But what that does is as you go further out of the money, that gets cheaper. So you can see in this example, you reduce the risk, actually turned it into a credit of $5 versus spending 40. And a ratio butterfly here is just adding additional bear call credit spread to this butterfly here. So you end up with the call debit spread and then 2 bear call credit spreads here. All right, so that's the ratio butterfly, and you can increase your potential down. In this example, you reduce your downside risk, and you're actually getting a $60 credit. So a lot of different ways that you can use these butterflies. Now, the most common one is the balance, and it's actually probably the best one to use because you can use it just for a multitude of different market situations. So let's take a look at the different, different butterflies and condors next. So first we'll look at a butterfly, all right, the balanced butterfly. And when we look at butterfly spreads, it comes down to how do you adjust your risk and your profit. So we can do that with the butterfly by the wingspan of the butterfly itself. So I'll show you the first one here will be a narrow wing butterfly where we've got our spread width of $100. So we could really narrow and reduce our risk by the width of that butterfly spread. So here's an example. We're looking for a directional move up here on SPY. These are great for SPY, the ETFs, QQQ, the Russell, the SPX, the index options. They're great for those, plus they're great for stocks. So in this example, we're looking, this is on the 14th, and we're just looking into expiration 2 days later. So short duration on this trade. We're looking for a move here to about the 618 retracement. I always want to have a target in order to establish the trade. And so this target then is 273, 274. And there's a lot of option activity, a lot of unusual option activity here. So it gives us a great target. So in this trade, we're going to do this $1 wide, make it really low risk. So we're going to buy the 272 call, sell the 273 call, and then buy that 273 call. Sell the 273 again and buy the 274. So we just structured a very narrow wing butterfly like this. Okay. So here's the butterfly and here's the body. The body is those short strikes right there. That's called the body. And then the wings are the long part of the trade. So in this example, by having a $1 wide or $100, the cost of the trade is $10, okay? 10 cents or $10. So you can see very low at risk. So if everything messes up on you, all you'd lose is $10 on one spread. So if you did 10 spreads, you'd lose 100. Now your potential profit would be $90, the spread width less that cost, and that would be like a 900% return. But if you got anything below that, you still have a fantastic return on your risk. So in this example, we had a $70 per spread profit, which on $10 of risk is a 700% return. So not too bad, right? $70, if you did 1, if you did 10, that's $700, but your risk is super low. And that's the great thing when you're in a really volatile environment. You can really control your risk. And if you mess up, you're not losing thousands of dollars, you're losing $10 or hundreds of dollars. So huge difference there. So here's what it looks like, the risk profile going out. And you can see it's going out there right, pretty much almost nailed it right there to 273. So this went from a 10-cent debit or $10 debit to $80 right here. And that's your profit of 70 on that risk of 10. So there's your 700% return. So in this example on, just 4 contracts, that's $280. And that little area in here, that black area is what's left of time decay and the volatility that's in that trade, because a lot of times you can't get it exact right into the expiration. So one thing that this benefits from is time going to zero and volatility going to zero. And those are 2 main pricing components. So that's where you can make these great returns. So that's a really narrow wing butterfly. So we're really controlling our risk there by tightening up that spread, making it very narrow. Now the next one is a wide wing butterfly. Okay, so the spread width on this is 300. The one I just showed you is 100, but look at the difference. So this is a short trade set up back middle of February, just recently, and we were looking for a move down. We had this huge move up, and we're looking for a move down to this kind of 382 retracement level, the 332. So we established a butterfly targeting that 332, and this was on the 18th. So another short duration trade. So these are great for like weekly options, for 3 to 4 days or out to 8 or 10 days. All right, so we're targeting down to 332. So in this trade setup, we bought the 335. It was trading at 336.40. So we bought the 335, sold that target strike of 332 using puts. We're looking for a downside move. Sold the 332, 329, bought that. So bull put credit spread, combination of put debit spread, bull put credit spread creates the butterfly. So in this example, it's a wider wing butterfly, $3 wide. All right, so we widened out that butterfly. We created a bigger profit zone or tent. Think about trying to catch a butterfly. The bigger bigger net you have, the easier it's going to be, right? But we increased our risk, not much though. You can see here it's a $3 wide or $300 wide spread. The cost on this trade, look at that, just 35 cents or $35. So that's all you would lose. One spread, if you did one spread, you'd lose 35. If you did 10, you'd lose 350. But your potential theoretical profit is the difference at 265 on that risk of 35. Here's a potential of 757% return. Now this went out 3 days later and it was up $156, not too bad, on 35 at risk. That's one spread, okay? And that's a 445% return. So where else can you get anything like this as far as risk reward kind of returns on your capital? There aren't any other option strategies or any other strategies, period, that have these kind of returns. So here's what it looked like going out on expiration. You can see it's going out right here, right there at 332.68. So it still has a lot of potential profit. That black area is still what's left of time value and volatility, but still a pretty good return. So it went from here, the put debit spread side was at $77, the credit spread side 42. So you can see that total profit was $156 on that capital at risk of 35. And these are also things that you can leg into. You know, I could have started out with a put debit spread or a credit spread and then leg into it. So that's the beauty of it. So, and the other big thing is look at the theta. You've got huge positive theta. So that's the other great benefit of the butterflies and the long condor. So that's a wider wing butterfly. And here's where it went out just at expiration. If you look at the total risk profile, it went out and expired right there at 333.60, up 105. But before the close, it was up even more than that. And so the profit you can see came from the put debit spread, the 335.32 went from a 77 debit to 140, and then the bear call credit spread side, the bull put credit spread side here, 332.29, 42 cent credit, and it expired worthless. So there's your the profit component of that. So that was a 300% return if you just let it expire, and that would have been okay as well. Now, let's take a look at another one. These are also great for the index options, which are European options where you have no potential assignment risk. So they're great for SPX, NDX, RUT. Those are great indexes to play. So here's a wide wing butterfly using SPX, and the spread width on this one will be $4,000. Okay, so here's how that works. But you can control this, this commodity, this price. If you bought, let's say, it's 28.80. So if you bought 100 shares of this, that's going to be 280,000. What is that? 2,800 times 100 shares. That is, $288,000. But you're going to see in this example, you can control this trade for just $400 of risk. So again, this is like using the SPY, but instead of the SPY, the SPX is like 10 times the value of SPY. And there's no assignment risk at all. So we were targeting down here to 2,800, and it was set up right here on the 8th when it was trading at 28.80, targeting down here to 2,800. So this was doing the long, the 28.40 put, short the 2,800. Okay, so $40 wide, and then 2,800 put, sold short, and bought the 27.60, so 40 there. So balanced butterfly, $40 wide, so that'd be $4,000 less the cost, which is your debit paid of 270. That's the maximum risk on this trade. But look here, if this was perfect and you made that perfect pin at that 2,800, this theoretically would make $3,730 per spread. Okay, so if you had one spread, $3,730 on your risk 270, that's a 1,381% return on your risk. Okay, or 13 to 1. You risk $1 to make 13. But you're never going to get that exact amount. But if you get close, it's still a fantastic return. All right, so here's where it went out. So it was trading 28.40. Here's the spread. So it went out here. It's pretty flat. That purple line is what it's doing in time. So this was going out on trade on the 13th. Expiration was on the 17th. But on the 13th, it was trading right here at 2011. So very close at 2,800. And at that point in time, this spread was up $465 per spread. All right, so $465 per spread. If you did one spread on 270, your risk, that's 172% return. So these are the types of trades you can just hit singles and doubles and singles, but then there's going to be that one where you nail it, and if it went out at 2,800, you just made, over $3,000 or over 1,300% return. But that's still fine, not bad to make 172% return, in about 4 or 5 days. So that's the beauty of it. And your risk, that's the thing that I love about it. Your risk is low, so you don't stress out as much overnight, especially on these types of trades. Now here's another example. This is Amazon, and this is a wide wing butterfly on Amazon. Now, so you could trade a stock like Amazon, which, in this example was trading at 1830. So that'd be $183,000 if you bought 100 shares here. We were looking for a move from this 1782 level where my pointer is to this 1830. This is where it kind of had resistance. So we were just looking for a move into there, very short duration trade, and just looking for that. And this was set up on the 29th, and it was going to expire then a week later on the 6th. So this is also kind of a little bit longer duration. So we can call this kind of a vacation trade. But here's the trade setup. So it was buying the 1820 call, selling the 1830 call. So we were going to that 1830 was our target, and then selling the 1830 call again, buying the 1840. So call debit spread, bear call credit spread. So $10 wide times 100, so $1,000 wide. The cost. Now look here. So your cost, your risk on this trade is $80, right? So you're controlling if you did 100 shares, you're controlling the underlying of $182,000, security for $80, and your potential theoretical profit on this would be $920. The 1,000 minus your cost, that'd be $1,150 per 1,150% return. Now, this is the cool thing about the butterfly. So this is the day of expiration. This was in the morning, about 9:30, 10 o'clock in the morning. So it was trading right here at the expiration date, and it was trading 1836, okay? So this went from $80 to 230. So that's up $150 per spread on risk of 80, 187% return. Not too bad, but look what happens 4 hours later going into expiration that day. This thing now is up 4 times that amount of money in the same day. So here it is 4 hours later, and it's trading pretty close to the same price, 1832. But look what happened here. It went from 80 to $695 on the spread. So now it's up $614, so 4 times more than it was at 9:30, 10 in the morning, and that's a 769% return, 4 times more return than it was just that earlier in that day. So that's the beauty of it, because it's stripping out that additional theta decay and volatility, which goes to zero at expiration. So that's the thing I love about it. Now here's an example of a long Condor spread. So very similar to the butterfly, but it's going to give you positive theta, which is I'm obsessed with having positive theta. It's going to also be a low capital at risk trade, high return on your capital at risk, but great for hedging. So I love this strategy for when you say maybe you start out with a call debit spread or a put debit spread, and then you want to lay off some of that exposure and also increase your theta to positive position. So you add a credit spread to it to create this structure, which is very similar to that butterfly, but we're spreading out the strikes here. So this could be a put, debit spread, or it could be a call debit spread, so that's the roughly the Condor structure. And this is great for hedging. And this was a trade, I've got an alert service, and this was sent out as an alert trade. Now, this is a directional trade, so we were looking on the 15th, this trade, Facebook was trading about 194 right in here, and we were looking for a move up to about 200, 199, 200. And so we did this for a very low risk trade to keep our capital at risk super low. So basically it's the combination in this example of doing, and we did this at one time, but you could have legged into it. So it's 195 call, then short the 197.5, so $2.50 wide spread, $105 debit on that, and then sold the 200 call, bought the 202.5. So you can see we skipped out $2.50 out on the spread there and brought in $30 credit. Now that knocked down our total then at risk to $75 with a potential return of 175, which would be a really sweet return on your capital at risk of 233. So total cost 75 cents or $70 per spread, and there's your kind of breakdown of the trade. So this went out right in the middle of the short strike, so it was almost a max profit trade. And that's the other thing, you can get pretty close to these being max profit. So this was going out right here at 198.58 right here. So close that out, closed out the call debit spread side. You can leg out of these. So that went from 105 to 249. So that was up $144. And then the credit spread side, the 200, 202.5 right here was under your short strike here of 200. So that expired worthless. You kept the $30 there. So risk of 75 and made 174, 232% return, in about 4 or 5 days. So not too bad. So that's the thing about these trades that are just so wonderful. So if you'd like to learn how to master these really high reward, low risk trades that work in any kind of market environment, there are 2 things that you can do now if you'd like. So I just gave you probably enough information to take action right now by yourself and figure it out as you go. But if you'd like to learn this kind of strategy a lot faster, then I hope you'll sign up and join me and sign up and register for my all new on-demand recorded butterfly and long condor option masters course. I did this right at the end of February, so this is a brand new course. It's a 6+ hour recorded course broken down in 30-minute modules or less. So you get all the video modules, they're yours forever. You'll get a log into our site where these are on the cloud, so you can always access them. And then you'll get the PowerPoint training manual, which are very detailed, 418-page there, plus another 5 enrollment bonuses. So let me give you that link here, and then I'll talk to you, and I'll walk you through everything you're going to get. So you should be able to just click on that link, and that should pull up a payment link for you, and make sure that works. Yes, it does. So that'll pull up this payment link, and you're going to get this all new on-demand recorded course, yours forever, plus you're going to get all the bonuses that I'll show you. So you should be able to click on that. Now let's go through. So it's powercycletrading.com/JVFly if you want to just type that in. So you're going to get the 6-hour recorded course. Now this is on my website, and you'll see it on my site for $397, but you're going to get it here today for $197, brand new course. You'll get the 6-hour plus course, a follow-up live Q&A, which will be probably a week from now. We'll send you an email on that. That will also be recorded. If you can't make it live, you can send in your questions. You'll also get my option trading tutorial, so basically another option course on the option Greeks and standard deviation. My complete option strategy manifesto, $47. Greek power tool, guys. These are things that you can print out, put on your desktop. And you're going to get a trial membership to my trading club for 1 month. All right, so all that today for this course for that one price of $197, and again, it's yours forever. Now, if you want to start the trading club at a different date, you just send us the email, and you don't have to start it tomorrow. You can start a week or 2 weeks or a month from now, and you'll get that. And then if you'd like to stay, then it's $97 a month, or you can get an annual membership for $488. So that's the options and the bonuses. So the 6+ hour recorded on-demand course here. 418-page training manual. This is a really detailed, thorough course, step-by-step blueprint course. Now, part 1 will go through the Greeks that are vital for these types of strategies, just what you need to know about that. And if you're a beginner for options, it's the perfect course because I step you through everything in a very, very, slow pace, answering questions as you go. So you'll be able to follow along, and the modules are 30 minutes or less, so you can always go back and forth to it. So you'll learn all about time decay, how that impacts the butterfly and long condor. You're going to learn about volatility, the importance of volatility, and what we call crush, and how that impacts the price and the benefits of that for this strategy. How that option pricing works, the effects of time and volatility on that, very important for any of your option trading. Part 2, then we'll go through the core basics that most traders don't understand about the butterflies and long condor. They're scared of these kind of strategies because they don't understand them. But this course, after you take it, you'll definitely understand how to use these strategies, which will also make it easier for you to use a lot of other option strategies. So you'll learn the butterfly long condor spread foundation, the vertical option spreads, how those combine to make these spreads, how, why, when to use the long collar put butterfly, wide wing butterfly, how, why, and when to use that, a broken wing butterfly, a ratio butterfly, broken wing ratio, iron butterfly, vacation, long condor, and hedging. So this course covers all these different variations of the butterflies. So you'll also learn what are the optimal times to put these on, what are the best vehicles, stocks, ETFs, index, or futures, how to structure these setups where you get that 10-to-1 or higher, like you saw in a couple examples, for just $10 of risk, how to profit from that option volatility crush, theta decay, And a major trading advantage of the long option Condor spread is how to use these vertical debit spreads and vertical credit spreads together. So these are great for legging into, legging out of, for hedging, etc. And these are things that can provide you 100, 200, 300% return on very, very low capital at risk. Okay, and then how, why, when to use the long option Condor. And then another really fun part of the trade course is using these type strategies for monthly option expiration, what we call pinning. And this happens 12 times a year. So you'll learn how to do option pinning plays and a step-by-step checklist of when to put the butterfly or long condor on, take them off, execution, trade management. And a big part of this course, the biggest part in my opinion, is learning how to hedge. Okay, if you don't know how to hedge, you're an accident waiting to happen on your trading. So you're going to learn how to hedge using the butterflies and long condor to hedge core positions or to hedge and defend vertical debit spreads or credit spreads. You'll also get my resource library with assignment risk, what that is, expiration risk, auto exercise, and a trading library of 58 pages of butterflies and long condors that you can review. So it's a fantastic course, and little feedback. Just when I think I have all I can learn about options income, Larry, blazing, amazing course, excellent class, Larry, as usual, under promise over deliver. Wish I'd known how to do these hedges before I lost so much money on my credit spreads. Thanks again for showing us so many ways of getting out of trouble. I love that because you get in trouble with your trading, but these will help you get out of it and reduce that trouble, sometimes even turn it into a winning trouble. Okay, so could it come handy in past, and my trading P&L would have been totally different. So truly my aha moment, Raj. So special enrollment bonuses, follow-up Q&A, option trading tutorial, 60-page option guide with videos going over the option Greek standard deviation, delta, probabilities, my 15 option strategy manifesto. So you get 15 of these different trade constructions of options, when to use them, like a back ratio spread, calendars, unbalanced, long straddles, strangles. You'll get my brief reference guide. So this you can print out, put on your desk for the Greeks, so you know what delta, theta, gamma is. You don't have to look around. And 1 month trial membership to our trading club. So you get access to our virtual trading room, open each day, each morning and afternoon with me. Daily trading updated videos every night after the close. Our weekly Q&A, we did one today every Tuesday, so you'll get that. And these are live and recorded. Educational Vault, 60% discounts on everything on my site, trading software and courses. I've got a lot of different trading software as well. So really a fantastic offer here, and hopefully you'll take advantage of it. And I hope to see a lot of you here in the future in the trading club at our Q&A. So I think I'm about out of time, and I just appreciate everybody being here today, and take advantage of that offer. And I think you'll be very, very happy that you did.